So welcome to this webinar today. Obviously on behalf of London Capital Group, my name is Jasper Lawler. If you have any questions at any point throughout the webinar, just feel free to send it through to this same questions box and I'll be more than happy to either answer the question at the time or maybe leave it towards the end. So moving on from the risk warning, the topic for today is how to trade the Dow. So our product for the Dow at LCG is called Wall Street, and it's one of the most popular products that we offer. And obviously that makes sense. It's one of the most well-known financial products out there to trade. And so the plan is to talk a little bit about what it's all about and the way to think about trading it. So these are the topics we're covering today for how to trade the Dow. About and a history of the Dow Jones Industrial Average, its full title, how the index is designed, weighted and calculated. I'm not going to go massively in depth on it, but it's just good to generally know exactly what it is you're trading. Gives you just a little bit more of an extra sense as to what can drive it. The top components and the important sectors moving the index, fundamentals that affect the Dow, bit of a sort of general concept here in terms of equity trading as well. Then I'm kind of can dig a bit deeper into as far as the Dow. You'll see when I get to it. The best technicals to watch. I haven't gone massively in depth on this. I mean, there's no space for us to talk about every technical indicator, but mention a couple of extra fields that you can look into. So make sure to stick around for that. And then we're just going to have a look at specifically how you load up Wall Street on the LCG trader platform. So it dates back to 1896, and so it was founded by Charles Dow and his business partner Edward Jones, hence the Dow Jones, and they founded what was then known as the Dow Jones Industrial Average, and it's one of the oldest and most significant indices watched around the world. It does have a heavy emphasis on the industrials. It kind of dates back, obviously you can see there, to the industrial age of the US. But these days it includes companies like General Electric, which is very much an industrial company, but also Apple, a technology company, and ExxonMobil, an energy company. So it's a price-weighted average, so we'll get into that a little bit more in a minute, of 30 of the biggest and most significant stocks traded on both the New York Stock Exchange and the NASDAQ. So careful distinction here from indices and exchanges, obviously. It's not like the NYSE composite, which is almost everything traded within specifically the NYSE, but misses the NASDAQ, or it's not the NASDAQ 100, which obviously only involves NASDAQ stocks. So this is an index which includes both those major indices. When they first started, there was only 12 companies on it, but obviously the US economy has grown quite significantly then and diversified a bit, and so these days it's 30 companies. It doesn't change, so the FTSE 100, for example, it changes its mix-up every quarter. The Dow far less often. The last major change was when Apple was added, and I believe it was AT&T were kicked out in 2015. So how the index is designed, your attention is probably immediately drawn to this this chart on the right here. So nice thing about the Dow, it is only 30 companies, so you can sort of focus your attention a little bit on those. And you can see it's actually quite interesting because yes, there are 30 companies, but the influence of these top companies are huge. So you can see that when we get down to Caterpillar, which is just 9 of the 30, Caterpillar all the way up through Boeing accounts for 50% of the index. So just those 9 companies can account for 50% of the movement of the entire index. So obviously the remaining 21 having proportionately less effect. But the ones you really want to watch out for are Boeing, and actually Boeing's been doing quite well this year and accounts for a large amount of the gains that the index has had, and you can see that it's almost 10% of the index. So that's just because Boeing's price, the stock price for Boeing is big, and the market cap of Boeing is absolutely massive. It's a borderline government company in effect. But obviously United Health as well is absolutely huge. Goldman Sachs, same thing. You can see actually Apple is a little bit further down the list in terms of its influence versus all these big huge companies, even though Apple itself is the largest company by market cap in the world. There's a distinction here when it comes to price and its weighting within the index. So keep in mind those companies there. If you hear some news pertaining to Goldman, it's important, or some Boeing or United Health, 3M, you know that that's going to have quite a strong bearing on the Dow. So as I said here on the separate section, it's influenced most by the stocks that have the highest price per share. Stocks with the highest share prices are given greater weight in the index. And so this is how you get the Dow price. It's a sum of the 30 prices, but it's not just divided by 30, but divided by the Dow divisor. So that's why when you add up all the stock prices in the Dow, you would think, well, okay, the Dow price should just be the sum of those 30 stock prices, but it's actually divided by this Dow divisor, which is how the Dow ends up being worth 17,000 or whatever it currently priced at, whereas all the individual shares put together don't come anywhere close to that. That's because of that Dow divisor involved. You don't really need to know specifically what it is. You're probably unlikely that you're ever going to be calculating the index yourself, but it's just good to know what you're dealing with. It's a value, numerical value that changes daily to keep the continuity of the Dow. So it allows for stock splits and mergers and all sorts of corporate actions that are happening all the time in these Dow companies. Charles making a bit of a joke in the chat room here. CUM percentage is just short for cumulative percentage, just so you know. So here is a list of those. Here is a list of those companies. Once again, just important to know that most of them are on the New York Stock Exchange, but you can see the ones that are the NASDAQ are actually those technology components. The Apple, obviously, Cisco, Intel, Microsoft, all listed on the NASDAQ. So hence, the NASDAQ still not as concentrated as it once was, but still those huge technology companies are still within the NASDAQ. So hence technology and the performance of that sector tends to overly influence the NASDAQ. And you can see that currently if you look on your charts, have a look at what the NASDAQ 100 is doing. Basically, not a few days ago, hitting a record high. Have a look what the Dow and the S&P 500 are doing. Not so great. And so here I have, I pulled this up from online, and it compares the sector weights of the S&P 500 and the Dow. So it's just an interesting comparison. Well, I suppose if you wanted to perfectly trade something that represents the entire economy proportionately, you'd have the influence on the GDP of a certain sector, and then that distribution within the index. And I think the S&P probably is closer to achieving that. As you can see here on this second chart down here, there's a massively, the biggest differential is when it comes to industrials. You do have other Dow indexes like the Dow Jones Transport Index. This one is the Dow Jones Industrial Average, and it's so it's obviously got a bit of a bent towards industrial. So that's the one thing you've got to keep in mind. And I think it goes to explain, why perhaps when there's lots of rhetoric about a trade war taking place, the big industrial companies tend to be some of the biggest multinationals who might be affected by a trade war, whereas you might say that technology companies might be able to kind of skirt that somehow if their business is kind of through the internet, which is less regulated these days, and less ability to get trapped by government regulation. Although, that is after the Facebook scandal, etc. Maybe that's about to change too. But you can see that most of the sectors are somehow quite well represented, quite minimal when it comes to utilities and real estate. When we're talking about the Dow, you can see materials actually fairly limited as well. So, unlike the FTSE 100, for example, which is massively influenced by materials and commodity stocks and miners, Dow less so. But you can see energy, quite an important aspect of it. Same as obviously it's basically Exxon and Chevron, which are driving the energy aspect of things. And obviously the financials, so the big banks in the US are important, less so since the financial crisis, but still pretty huge. But it's even though they have a bigger weighting in the S&P 500, technology is still the second most important sector within the Dow after industrials, which I think is a fair way to explain the US economy, because it is a lot of the growth is heavily weighted towards technology these days. So digging into a little bit about the fundamentals that can drive the Dow, and so if you are following the news and wondering what's moving the index up and down, and the good thing about the Dow is generally it's people's barometer for the market. So if you say the market's up or down, it's a good chance the Dow is the sort of main barometer for that. I mean, less so outside of the States, but it is, obviously the United States is still the world's biggest economy, so everyone's still paying a lot of attention to what's happening in the States. Particularly with the Donald as president. So I wanted to just kind of reference these two different approaches here, and as I said at the start, this is something that you can basically apply to any kind of equity analysis. It's more that this kind of top-down versus bottom-up approaches to analysis is more geared towards individual equities, but it's a good way to kind of split apart the different ways you can look at the trading indices as well, because in essence, you can either look at the big picture, which is essentially the economy and the different things I've listed there, and I'll go through that in a second, or you can look at just the individual companies within the index, which is a lot easier to do with the Dow because there's only 30 of them. And if some of those companies are just doing very well, you're looking at their earnings and they're absolutely taking off, which obviously was the case in the last earnings season in the US, helped heavily by the tax cuts, then then that's a good basis for investing in the entire index. If all the individual companies that make up the index are doing well, or most of them, then obviously sure, buy those individual shares, but you can also buy the index. Is often a kind of cheaper and easier way of doing it. So if I dig a bit deeper into this, it's obviously a lot of times about the economy. I would say generally market commentary out there, which obviously I do a lot of, focuses a bit too much attention on the economy. The day-to-day movement in the stock price, there's only so much it can have to do with the economy. And even if the outlook for the economy remains pretty unchanged, you can have 10, 20% movements down in the stock market in a period in which the outlook for the economy remains pretty much the same. So there's over this kind of shorter term basis, only so much influence, but generally speaking, it makes sense, obviously, that if the outlook for the US economy is good, the outlook for the companies that operate in the economy are going to be good too. So the stock market should rise in sync with the economy. But it's not just the US economy that affects the Dow. Trade partners like China, if it's one thing saying America first and trying to sort of take jobs or economic growth away from China, but actually in terms of stock markets, the performance of the global economy, arguably, especially for these big international firms, more important than just the US economy. Particularly, a big factor to look at is where some of these companies get their earnings. Some of them, more than half of their earnings come from overseas. Monetary policy, obviously pretty huge these days. Federal Reserve gradually raising interest rates at the moment. So this relates somewhat to the next point where I say it's relative performance versus bonds and yields. Basically, you get to a point where if the Federal Reserve keeps raising interest rates and bond yields keep having to rise to reflect those higher interest rates available, then you get to the point where actually the expected return on the bond market, which is generally considered safer because if you hold it till expiry, you should get your full capital back on the bond plus that rate of interest, whereas obviously if you hold shares, you're not guaranteed to get your capital back because the shares move up and down. So that safer investment gradually gets a higher return, and suddenly investing in the riskier market like stocks gets less attractive. So that's kind of what we're getting to at the moment, and that's this chart I've got over here with the yellow line is US Treasury, the yellow line is the Dow Jones, but you can see that actually this white line is the yield on treasuries as well. So I think this is perhaps slightly out of date, but yeah, it's only covering 2017, is it? But you can see we've actually moved beyond 3% since then. So hence some of the concern about what's happening in the stock market. You know, you can see that there was a bit of a, when yield started to push higher here, you know, that was the stock market was still high, but it was a kind of early warning sign the stock market was about to roll over because of that same concept. Skipped over the talk of sectors. You know, it could be said that for most of last year, a lot of the sectors in the S&P and the Dow were a bit drab, weren't doing so well, but technology was so on fire that it still made sense to invest in the Dow. So if you've got a good handle on technology and how it's being used and the companies that are employing it, and those companies are making good money, you can actually invest in the Dow just purely on the basis of your understanding of that sector performance of tech versus the rest. Equally, you know, oil prices heading higher, for example. You know, maybe it's been a bit of a down period for the price of oil shares. If you think they're about to rip higher, you know, they can actually pull the energy shares higher and thus pull that whole index higher too. And it was a kind of interesting phenomenon when in 2014 oil prices really nosedived. That actually brought stock markets lower. You would think that, oh, lower oil prices, that's good for all of us because we're all going to, you know, we're spending less money when we fill up our tanks. That must mean we're going to go spend the money on other things. But actually, from a stock market perspective, those oil companies have such an important place in the market that the most immediate effect of the lower oil price was actually that those companies are making less money from selling oil. And then that's the kind of top-down approach. And I think, you know, especially if you are trading indices with LCG, you can obviously trade them alongside things like Forex and commodities. It's all part of a sort of similar picture that you're forming. It's all this kind of macro approach, which is a lot of the analysis that I put out there for LCG is kind of on this kind of macro basis because it does cover these kind of top-level markets rather than all the individual shares. Bottom up is the other way around. As I said, you know, you do just look at things like the earnings growth of the companies, the financial ratios, the PE ratios, the kind of products and services and the market share these companies have, and put all together, does that make the stock market a good place to invest? And a little bit on the technicals. As I said, I don't dig massively into this because I've got so many webinars I'm doing on technical analysis, but worth talking about market internals, and maybe this is something I could do a separate webinar on for those who are interested. But how many shares are participating in the rise and the fall of the index? For example, the AD index or the advanced decline indexes, it can be interesting to look at. So for example, you've got 30 shares in the Dow. If the index is moving higher, but if you look at the performance of the day, and there's only, for example, 10 out of the 30 of the shares were rising, well, you know, you've got 20 shares who are falling. There's only so long that can be sustained. Eventually, either those other shares have to catch up, but oftentimes what you'll find is that those other shares lagging behind are a kind of precursor to where the overall index is going. So you can talk about things about like market breadth, and if the market has good breadth, generally lots of the shares are moving up together. When it has weak breadth, that's when you've got a number of shares kind of going against the overall market trend. So that's the internals of the market, how all those different shares are moving together. Because obviously, keep in mind, when you are trading these indices, you're in fact trading an average, right? But there can be a lot of distortions within an average. There could be some companies that are doing very badly and all doing very well, but altogether it makes an average price. Or the companies could be all doing kind of a bit mediocre, and that makes the average. Another thing to look at, sentiment. So some of the best tools for looking at sentiment are for the stock market. It's not as easy to do in Forex and commodities where less information is available. Things like the number of put and call options being taken out and the ratio between those. When you get a lot of people buying puts, that's generally the market's had a massive sell-off. It's a contrarian indication that actually market might be about to bottom. If a lot of people buying a lot of calls, generally means the market's been ripping higher for a while. They're getting a bit overly bullish. It's a contrarian indication that actually the market might be about to put in a little top. And then as far as technical analysis, it was all the usual tools that work: support and resistance, candlestick patterns, etc., etc. They all work very well in indices trading. Thanks everyone, much appreciated for attending. Good luck with trading this week. Jasper signing out.